Hi, this is Shane with The Rational Trader. It is Sunday evening, May 5th. Happy Cinco de Mayo. I was traveling last week, so no daily videos last week. So this is the weekly review for last week. So let's look. Actually, what we want to do here first is look at the last 2 weeks, because that's when we started the method we're using here to target fewer trades, but still give us opportunity to take advantage of the moves in the market. So trade activity log, all orders, all symbols non-sim since 2 weeks ago. So plus 490 on, if you add this up, this is 26 trades. So that's 10 trading days, 2.6 trades per day across 4 markets. It's actually lower than we're targeting, right? We're targeting about one trade per day per market. So it seems in line with what we're after, since that number is an average. One trade per day is an average. The day that kind of jumps out at you is that one, because there's 7 trades. We're going to go look at that day specifically. There's a reason that number seems too high to me, but there's a reason for it, and it makes sense. And it kind of depends on how you choose to trade the market, whether you're going to do an ad or not. Okay, back from a brief interruption. So we're going to take a look at this day specifically, because I want to go over why that number is as high as it is and the choice that you as a trader have to make. But before we do that, let's look at each market individually across the last 2 weeks. Let's do CL first. CLM9 is plus 500. So we're plus 490 across all the markets. So you can see where all the gains are. It's in this big oil, this nice oil gain we got right there. So plus 500 on, I can't do basic math if I'm on 8 trades, so that's very, very reasonable. Let's look at 6E, which would be the next most active market. And, small loss, small loss, small gain, small gain, small gain. So up 25 on 10 trades, is that right? 9 trades. Okay, so that's probably a loss once you factor costs in, a small loss. But again, we want to go look at that day and see what's going on there on May 1st. All right, and then let's see, 6J. So the yen across 2 weeks, only 3 days where we took trades, a scratch, and then 2 losses, so down 75 on 3 trades. And then gold, GCM9. So gold had, not a great trade, but not bad either, 210. And then 1 loss. And then this is the day I kind of didn't like in gold. Minus 100 on 3 trades. So that means I was up 40 and then took 2 losses, something like that. Typically, I'm not, I'd rather see. I guess it doesn't matter. If it's one of those days where things aren't going to work out, just take your 2 losses and be done. Here we have an extra trade, so we have an extra round of costs there. All right, so again, let's go look at this day, and it's the euro and oil that we want to take a look at. So let me go find that for you. Hold on. All right, so here's oil on May 1st. It's the day we're interested in. Why were there so many trades given the small getting. This is the oil news here. This craziness right in here. Whoops. This craziness right in here. Right. That's right at 7:30 Pacific. So we're standing aside until 7:35, and then we get short right there, basically on that break. That break of that level there. Okay. And then what happens is we add right there. All right. And then the market pulls back. And so the add takes a loss. So you can see down here we made 23 ticks on the one trade, but we lost 14 on the add. All right. So if you're not doing ads, you take away that minus 14. You'd still make that 23. And this is where you've got to make that choice whether you're willing to do this or not. To me, the whole idea is to catch that runner and then add to it. So what the system does is when it does this add, it sets the the stop to break even +1. So you go from whatever your gain was to a potential scratch, and then you start trailing again by, in this case, 20. So that's why you have a -14 loss there instead of, we're dealing with 7-tick stops. So we don't move the stop to here -7. We move it to the new break even +1. All right, we want to give it more room is what we're doing here. And in this case, it just pulls back enough that it takes us out. So we end up, losing 14 on this contract here, and making 23 on the original one. It's a very, and then later on there was another short right there where we just scratch on it. Okay, and then that was it for oil for that day. Let's go look at euro for the same day. All right, so here's the euro for that day. Overnight there was a short that scratched. We actually took some slippage on the stop because we actually the stop would have been right there. So 0 ticks. And then we got long down here, just beautiful entry long here. We catch this nice long move. We add here, it's very similar to oil, but going long instead of short. We add right there. This is after this pullback. You can see what the machine is thinking, or doing anyway. On that pullback, add back in. And instead the market pulls back pretty hard. And again, you'll notice here that this pullback is actually really deep, but it's not enough to take us out because we're moving that stop to break even +1. So it's enough that if the market takes off from there, we're able to take advantage of it. As it happens, it's just absolutely agonizing. We get stopped out to the tick right there. So we're trailing by 20 before the market pops higher. And then to add insult to injury, the system actually takes a short right there and then loses 7 ticks. So on the nice trade here, we make +23 -12. All right, with an agonizing stop out right there, and then we lose 7 on this short right here. All right, so it comes back to it's really the same thing. The times when you really clean up is when you do that add and the market continues to run. So I personally will continue to do that. As a member, you can choose to turn that off or on. As a quick reminder, the way to do that is just these 4 different add types. Just set these values to 0 instead of 1. All right, so that would look like this. All right. So now it won't look for an add when there's a break of a wave. This is add after a pullback. Add on a runaway is related to the speed of the market. So if we see 3 bars in a row where the average speed is increasing, the total average of the wave speed, the average speed of the bar for that wave is increasing. It's actually a fairly complex calculation. Then we add there. That's for those cases where the market just takes off and just rips higher or falls apart. And then this other kind is a sort of specialized kind of pullback, PRP type 2. Long-time members will know what that means. All right, so you can just turn those off or not. And then in this case, for this particular day, for both those markets, I would have been better off doing that. My numbers would have been 14 and 13 ticks higher in each of those 2 markets. But again, that's I'm in it for that big move, so I'm going to go ahead and continue to do those ads. And that's it. So the other thing to be thinking about, the reason I went through the activity log market by market is that it seems pretty clear to me that it's very reasonable to pick your market, whatever your favorite market is, and just trade it using these settings. So we had talked about taking more risk per market, since if you're only going to trade a single market. But I look at this and I'm perfectly happy with what I'm seeing. And if I'm an oil trader, then you know, that's only 4 days out of 2 weeks did I take a trade. And, you know, very reasonable number of trades. What is that again? Is that 9 or 8 trades? You know, plus 500. So we need more time. We need more data. 2 weeks is not enough data. And in fact, if I recall correctly, that first week is somewhat truncated because I had made a mistake on the first 2 days. So that's not even 2 full weeks. So let's I want to let this continue with the current models and the current targets in terms of trades per day, and see how we look after 4 weeks, and then that'll be it's starting to get, that's still not statistically valid in terms of enough data to make a decision, but it'll certainly act as a good guide for us. All right, so that's where we stand right now. Let's go back and take a look at the full, what was the full number again? I gotta write this down. Plus 490 on 26 trades after 2 weeks. Again, this is modeled on a $5,000 account. All right, taking 7 ticks of risk per trade. All right, that's it for today. See you next time.